You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
All right, so it's in thick of earnings season, and there's a lot of interesting company stories coming out. And one we want to highlight right now is Baker Hughes. It's an oil field services company with really two main businesses. One is legitimately just oil field services. You're helping oil producers make more oil out of the ground, offshore and onshore. The other one is called Industrial and Energy Technology. That's new energy. That's LNG. It's export facilities. Two big businesses. Revenue came in for the fourth quarter at about $6.84 billion. Earnings came in at 51 cents a share. And we're joined now by Lorenzo Simonelli. He's chairman, president, and CEO of Baker Hughes. Lorenzo, it's so good to see you. Thanks for joining us today.
Alix, good to be with you as always.
So listen, the stock is down 3%. The commentary from Analyst is your outlook isn't as rosy as your peers like Halliburton and Schlumberger. What do you say to that?
I would say, first of all, we're coming off some great results in 2023, and also we've laid out a clear strategy as Baker Hughes over the coming years. As you look at 2024, we've given a guidance that is a balanced approach with all of the geopolitical and also uncertainty that's happening around the globe. So we stick to our guidance, and we think that we're executing. And as you look at the guidance, we've got considerable growth in 2024 and great performance as well.
So what's the biggest question mark, I guess? So if you're more conservative than your peers, where is the question mark? Is it going to be the new energy orders? Is it going to be onshore demand, or is it going to be offshore? Is it domestic or international that has you thinking and questioning the most?
You know, you look at what's happening around the world and you see the geopolitics, you see what's happening from the OPEC cuts, you see what's happening from the consolidation in North America, and that leads some uncertainty relative to the activity levels within North America land. We still see that U.S. North America should be flattish, but U.S. land will likely be negative for the year, given some of the consolidation and also some of the activity. International, again, will be in the high single digits, so we still see that being robust. And I think, again, as we look at giving guidance, we're taking a balanced approach to what's taking place around the world at this moment, and also giving a predictability to our investors on what can be achieved and also confidence in what we can achieve.
Lorenzo, I just looking at your business here, and I see that about 3/4 of your revenue comes from outside of the United States. So obviously, you are attuned as much as anyone to the geopolitical risks around the world. What are you telling your investors about, what's happening in Eastern Europe, what's happening in the Middle East, and how that may impact your business?
We're telling them that we've taken every caution, and also we're managing the situation. We haven't seen any impact, and we don't anticipate a big impact, but we do think some of the development plans may be delayed slightly over the long term. No change in what the NOCs and also large customers are laying out from a capital spend, but there may be some, I would say, delays. Again, as we look at the outlook internationally, we're still anticipating high single-digit growth, and we think that international is a key place for us to be, and we look to perform there over the coming years.
Lorenzo, what's your take on the demand side? I guess that would focus more on oil, and it does also hit on the Red Sea issue, but what's demand going to look like for 2024? I'm getting notes about 2025, but I have no idea what's going to happen this year.
Well, Alix, it's always difficult to predict some of these elements, just like it is oil price, and you know this space well. I think demand continues to be robust. A lot of it's going to depend on the economic situation as you look at some of the events unfolding also globally. And we anticipate that, again, demand will increase this year and but continue to be strong, especially in the developing world.
What are your customers telling you here? I know you obviously close contact with them. What are they telling you about their spending plans over the next couple of years?
Again, it varies. You've seen in North America, obviously, some consolidation. So people are going through that consolidation, and they'll be looking to adjust some of their spending plans in the short term. But again, continuing to be robust on the long term as you continue to see the demand be there. On the international side, these NOCs have multi-year projects that they're executing. There'll be some variation in the timing of those, but again, the long term continues to be solid. And as you look at our guidance, again, we're anticipating that maybe there's some tempered view on some of the pace of the developments, but the developments are going to happen.
NOC, Paul, just National Oil Company.
Thank you.
Just I'm hooking Paul up with the oil jargon there. Lorenzo, you mentioned the M&A situation, and I find that so interesting because that was one of my questions to all these CEOs when they announce these big mergers is, are you actually going to be slowing your oil production growth over time? And they're all like, no. It's going to be really good. It's going to keep growing. What do you think that timeline actually looks like? In the beginning, there's synergies, they get more out of the ground, but then that tapers off. What do you notice?
So as you look at the normal evolution of consolidation, we've seen this cycle before. You are going to continue to see production increases, but you're also going to see synergies between the consolidation. And as they go through their integration activities, I think you'll likely see some tempered measures relative to some of their procurement. But again, production, they're going to seize the opportunity to continue to increase production as the demand is there.
Yeah, I mean, I'm not an expert in this, unlike Alix, but a term I used to hear a lot, and I don't hear it that much anymore, is peak oil. When are we going to be at peak oil? Are we at peak oil? I don't hear that discussion anymore. So when you're talking to investors, how do you talk to them about the long-term kind of demand for oil?
You've got to look at it from a standpoint of the energy transition is going to be multi-decades, and it's going to require an energy mix that is abundant of providing as clean as possible fuel sources to the public. And that means oil is going to have a role to play. And we see oil and gas in particular having a strong, robust outlook as we go forward. And the question on peak oil has been asked many times. There will be a time when peak oil comes. I think it's not at this stage. And we continue to focus very much on gas and also LNG.
Well, and speaking of, so LNG, Paul, is huge for Baker Hughes. So they help to build the export terminals that you get. And that has been a humongous driver here in the U.S. And just to focus on that for a second, they booked about $169 million worth of new energy orders in the quarter, and overall for the year, $750 million. Like, that's growing at a very rapid clip. Lorenzo, somehow restricting LNG exports in the U.S. is becoming something people are talking about. The permit process has gotten a lot slower. What is going on?
Alix, it has gotten slower. And again, we're monitoring the situation. And I'm disappointed because as you look at the benefits of US LNG, not only for the US, but also for the world, and also what's been achieved with the geopolitical uncertainty and also providing to Europe, there's been commitments that have been made. And we should continue the US LNG exports and also the permitting of these projects. That being said, international projects are continuing to move forward. And we have an expectation that, again, in 2024, there'll be 65 MTPA FID'd. And we're, again, seeing about 30 to 60 MTPA FID'd in 25 and 26. And by 2030, there'll be a global capacity in place of 800 MTPA. So, we'll monitor the US situation. It's disappointing. I think it will sort itself out. There's been a lot of commitments that have been made to international partners.
Because, again, Lorenzo, I've learned so much just from talking to Alix about the energy business. And now that the U.S. is a net energy exporter, it just seems like the natural gas part of the liquefied natural gas part of it has to grow. I guess my question is, if I wanted to go down to Corpus Christi and hire you guys to build me a LNG facility, could you do it?
Yeah, you have to wait a while. Their backlog's really deep, Lorenzo.
We have a very good backlog, and we continue to grow our backlog in LNG. And yes, we can build. We have the most versatile portfolio of solutions around LNG: small scale, large scale, stick, modular, onshore, offshore, floating. So you're coming to the right place, Baker Hughes, for LNG.
And I should point out MTPA, million tons per annum. So it just basically means the capacity, like how much you can actually process and export, because you got to cool the natural gas down before you export. Lorenzo, I am going to see you next week for the annual meeting in Florence. The talk will definitely be Italy.
Wait,
yeah,
you're
I know.
going to
I know you
what?
hate me, right?
Not Florence, South Carolina,
No.
Florence, Italy.
They hate
oh,
me, Lorenzo.
Nice.
And the talk is definitely going to be revolving a lot around that LNG story. For investors just looking at the numbers today, the stock down 3%, what's your main message before we get to the broader outlook next week?
The main message is we're coming off a terrific 2023 where we posted some record results. Our strategy is very clear. We set out guidance that continues to grow the business, continues to post improvements in our EBITDA margin rates. We're expecting OFSE to be at 20% for 2025, IET to be at 20% by 2026. We're not changing those expectations, and we're taking a balanced approach to 2024. But when you look at the guidance, it continues to move the company forward and also post very good results.
Lorenzo, I really appreciate that, the conservative approach and then sort of moving a lot faster in the next couple of years. Thanks a lot. I look forward to seeing you next week in Florence, Italy. Thank you. Lorenzo Simonelli,
Look forward to it.
He's chairman, CEO, and president of Baker Hughes. Now we're going to do something that only Paul and I can do. Talk to a CEO, then bring a Bloomberg Intelligence analyst who's been covering the company for years on to then talk about it. This is what we can offer you on the Bloomberg Intelligence show every day. Scott Levine, he covers oil services for Bloomberg Intelligence. What did you make of the move today, the numbers, and just talking with Lorenzo in the last 10 minutes?
Yeah, no, I think so. The stock is down a bit today, and we've seen Halliburton and SLB up on earnings over the past week. Frankly, the guidance that Baker gave today for mid-teens EBITDA growth is almost identical to what SLB gave. I think the difference here is probably the conservatism around the messaging, number one. Certainly the low to mid single digit decline that they're calling for spending growth in North America, high single digit growth in international trails what we saw out of both of those two companies. And then secondarily, LNG, as you mentioned, is a really big driver for Baker. That's unique to them, certainly much more so for them as a producer of modules for LNG plants, which neither SLB and HAL do. And I would say that the commentary there was maybe a little bit more downbeat as well. They're looking for modest growth in FID capacity this year. They focused more on some of the businesses outside of that. So I think it's probably more so the tone out of Baker being a bit more sober than the guidance per se, which was in line with consensus, and the growth outlook similar to what we saw out of the peers there.
So I'm looking at the ANR function for Baker Hughes, Halliburton, all the comps. The street likes this stuff. They like these oil services companies. What's the bull call on this? Is this people going to need oil forever?
Yeah, well, they are investing in the future with the energy transition and the new energy business as well. But I think, so look, 2 years ago, 2022, this group was outstanding, right? The group was up 60%, the market was down close to 20%. Last year, the group performed okay in a much stronger market, and the growth expectations for the group have moderated and are moderating still in 2024. I think within that context, folks are still comfortable with large cap, globally diversified oil field service companies like Baker Hughes, like SLB, to a lesser extent Halliburton, because they're more focused on North America. But they're still comfortable with these companies. They're large, they're global, the balance sheets are in good shape, they're returning more than 50% of the free cash to investors. And so that appeals to investors that kind of are attuned to this new energy environment where it's disciplined growth and capital returns rather than the wildcatter mentality. So I think
That's
it's
what I like. I like the wildcatter.
He likes that. I called SLB Schlumberger. I'm definitely going to hear from them later. But SLB. So to that point, though, I feel like if you talk to SLB, they'll talk a lot about digitalization and all that kind of stuff. Whereas Baker Hughes talks really about LNG. And they build these big terminals. They help to do that, like with the likes of Bechtel, for example. Yeah. Do you feel like at some point these guys are going to be, you can really bet on them in different ways? Like, I'm going to bet on Baker Hughes for LNG. I'm going to bet on SLB for an AI component and digitalization. Like, can I do that yet?
You can, and I think those are accurate depictions of the business, but I wouldn't overstate their significance. Like, I feel like Halliburton gets maligned a lot for the North American exposure, and
they do some solid international.
It's over half their business.
I totally didn't know that until your note the other day.
But SLB is 80% international, and these guys are closer to SLB than they are to Hal in terms of that geographic split. So, while the statement is true, I think it's equal parts branding and as it is the business mix, and investors are naturally going to look for ways to differentiate between the companies, and so they'll gravitate towards the differences more than they will the similarities. But I think there are a lot of similarities in the balance sheet. All the companies are focused on global markets to more or lesser extent, and so with Baker, the LNG emphasis is a differentiator for sure. They have a much bigger equipment business than either SLB or Halliburton does, and so it's natural for folks to focus on that specifically, and some of the weakness in demand out of Europe maybe is weighing on that story a little bit, but it's still a very strong business for them.
And if I were an investor, I would prefer my oil field services and equipment companies to be more international rather than less, given how tough it is to get stuff done here in the U.S. Is that right?
Yeah, I think certainly there's much more visibility on
Not 8 years ago. That would be a different statement.
Yeah, I guess it depends what time we're talking about. And look, shale had the year that the energy, blew the lights out, 2022, shale came back much stronger from COVID than international markets did. They came back faster, but they got crushed more significantly. And so that was a little bit of a 1 year snapback in shale. And so, we're now past that. International really reaccelerated and overtook shale toward the middle of last year, and the expectation is that they'll do so again this year. So I still think there's much more of a multi-year growth visibility on international, including offshore.
Energy is definitely going to be a talking point in the presidential election. The reality is a little different. When we say drill, baby, drill, we're going to unleash American energy independence, my question is that not happening? And then my other question is, are we going to see restrictions or any sort of slowing down of LNG exports?
Regarding the latter, I don't think so, no. And I don't, yes, we've already heard some of the drill, baby, drill mantra, and I think,
13 million barrels a day ain't good enough?
That harkens back to a different time. That's, I think the intent there is for voters to see that messaging, right? But the area where I think you probably see the most difference, frankly, is in the energy transition technologies. And, for example, Plug Power yesterday was up 30% based on enthusiasm for them getting a loan from the Department of Energy. And so, there's been some concern and pushback regarding the incentives around hydrogen development, et cetera. And so if we were to see a change anywhere, I think, if indeed we see a change in the Republican Party getting the presidency in 24, it'll be with regard to the incentives for the energy transition, and maybe that getting some cold water thrown on it. But as far as U.S. oil, during the Biden administration, production's grown fine, despite some of the tough talk you heard about cracking down on leases in the Gulf of Mexico. Offshore has done just fine, and I don't think it's much of a difference factor in terms of conventional oil and gas.
So great. Scott, thank you so much. I appreciate it. Thanks for answering all my emails with my chicken scratch handwriting too earlier in the day. Scott Levine of Bloomberg Intelligence. He covers all the oil field services.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Anna Rathbun, CIO at CBIZ, maybe CBIZ Investment Advisory Services, Independence, Ohio. That sounds like really right smack in the middle of Ohio, if I had to guess. I don't know. Anna, thanks so much for joining us here. Again, I thought we might take a meaningful pause here in the first quarter with these markets, given the real rip we had in November and December. What do you make of this market here as we kind of get into the back half of January in 2024?
Sure. Thanks for having me. And actually, Independence, Ohio is 10 minutes south of Cleveland. So we're actually in
there we go.
northern Ohio. So they should really said Cleveland, Ohio. But anyway, S&P, it's kind of surprising after all the bearish talk last year that we would be reaching record highs multiple days in a row. It looks like today might be another one of those days. But it's important to remember what's driving this, right? I mean, everyone's talked about tech driving this Magnificent Seven becoming even more magnificent. But, there may be a reason why. If you look at the underlying trends in the S&P 500, you do have tech leading, but how many stocks and how many sectors or sub-industries are actually hitting those record highs along with the S&P 500? The cyclical parts of the sectors that represent the cyclical parts of the economy, they're not reaching record highs, right? So this is a reflection of some of the changes or the bifurcation that we see in the economy being reflected here. So do I think that tech can continue to run? Well, look, I mean, I think that tech is a part of utilities. The pandemic has taught us that it is a part of infrastructure. We can't live without it. It is part of our daily lives. Some people might say Netflix is a part of their, social infrastructure, as we saw today. I don't think tech is going away, and there's a reason why they're doing so well during the earnings season. So I don't know if it can continue to run at such high valuations. We might be expecting more than perfection from them for the rest of the year. But certainly this isn't some kind of a bubble that's forming.
Well, so I love your idea that tech is safety, like it's utility from that end, because I've wondered that over the last 6 to 8 months. And I do wonder if earnings then matter. I know that's like sacrilege in the middle of earnings season, but then if that's the case, you just buy the dip. And that's why basically the market just doesn't want to go down.
Right. And also, if you think about how far we've come with tech, I mean, they're taking up so much of that index. So if there is buying the dip, it's actually also magnified. Now, one risk is if we do hit a soft landing patch where, we're maybe pricing in a soft landing, but maybe there is actually growth happening if the Fed lowers rates, maybe March, probably not, maybe in May. Then we may have recurrence of M&A activities, some more exciting opportunities that can be financed at a cheaper cost. If that happens, then there is a risk that some of the money that went into the buy the dip may be going back into some of the cyclical sectors because they are so cheap.
Speaking of technology, Meta Platforms, formerly known as Facebook, it is up about 1.8% today, all-time high. Now has a market cap once again of $1.01 trillion. So the tech play is still in play. Netflix up 14% as well.
Not even that, but ASML, a tech play over in Europe, is also set for a record close. Like it's sort of encompassing many different types of tech.
It is. It's kind of across the board. Hey, Anna, what do you think? What do you think, or what are you guys discounting in terms of Fed cuts in 2024? I mean, the market is anywhere from 5 to 6, and a lot of folks are saying, whoa, that's a little too much. How do you guys think about that?
Yeah, I do think that 5 to 6 is probably too much. When it was really pricing in 6, I thought, wait, maybe something might go wrong if we need 6 rate cuts. But here's the thing. The Fed officials have been slowly walking things back, right? So I feel like they're trying to set us up or set the expectations so that it wouldn't be such a surprise if they don't cut rates, if they don't wait until the second half of the year to start cutting rates. So maybe in March, maybe we don't get a rate cut, but maybe we get a repositioning of where the Fed might be. I think the biggest surprise is going to be if the Fed actually says, we're revisiting the 2% target. Maybe it's 2.5. Maybe it's 3.
Well, but that would be okay. If they came out and said, we're going to revisit and go to 3, that would be huge.
That would be huge, right? But the thing is, Fed's super core, which is services minus food, energy, and shelter, month over month has been at 0.3%. That is not at 2%. So if the Fed wants to start, and that's been there for a while, so if the Fed wants to start earlier than the second half of the year, they're going to have to come up with some reason because they've been telling us services, super core. we're not seeing any easing there. And actually, the PMI today, right, that came out, services still very strong, and that's a larger part of the economy. And inflation in services tends to be stickier. So we're going to have to see some concessions somewhere to justify an early cut. But certainly, the expectations have been heading in that direction.
All right, Anna, thanks so much for joining us. Anna Rathbun, CIO at CBIZ Investment Advisory Services, Independence, Ohio.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
Boy, I'm looking at Netflix, Alix. Really good quarter in terms of subscribers last night. They're also talking up a big advertising game over the next couple of years. Stock's up 13% at a 52-week high here. It's not at its all-time high, but it's very close. Over the last, 12 months, it's up 53%. So nice move for the folks at Netflix. Let's check in with somebody who knows this digital advertising, digital media business really, really well. Friend of the show, Mark Douglas. He's the founder and CEO of Mountain. He's zooming in from Miami. I mean, nobody zooms in from like Cleveland in January. They zoom in from Miami.
Yeah, but
so
we literally just had someone from Cleveland.
We literally just had somebody from Cleveland. But these media types. Mark, thanks so much for joining us here. Boy, let's just start with Netflix. A couple things. One, love to get your thoughts about kind of what the results from last night. And then two, love to get your thoughts on getting into wrestling.
Well, let's start with the wrestling. I think that's the most interesting part of it. You know, what the thing about Netflix is with every other streaming network, you have to have a show you want to watch to go there. With Netflix, you just go because it's Netflix,
Yep.
and then they make the shows popular just because they have this massive audience. And they essentially did that for Formula One. And obviously, Formula One was already a big popular sport, but they made it, really expand the audience and increase the value of Formula One. I think they're going to do the exact same thing for WWE. Like, what was the likelihood I was going to watch a WWE event, yesterday? Very small. Likelihood now, very large.
I have to say, Mark,
it's just sitting there.
I agree with you.
Yeah.
Like, I don't necessarily want to watch WWE, but like if they did a documentary of it, 100%, I'd be in on that. Are you worried about content spend? Like, is all of that just going to cost too much for what Netflix is promising the street?
Well, I mean, that used to be a huge problem with Netflix, meaning, on Wall Street, people are like, this company will never make money. And then they focused on profitability and they proved them wrong. And so I think they have that pretty much under control. And then obviously the ad business is just pure profit. Like every dollar revenue they bring in there, net of paying their sales reps commission is just more profit for Netflix. So I think they have that formula very tight, and it's reflected in how the stock market has responded, the value of the company right now.
So, Mark, let's just step back a little bit, because one of the growth drivers for Netflix, in addition to wrestling, I guess, is advertising. Now, this is a business that Netflix has said repeatedly and pointedly that they're not going to get into the advertising business. Well, now they're into the advertising business. And this is your bailiwick. This is where you guys operate at Mountain. How do you think they're going to do here? And then what's that mean for the industry?
I think they'll do well in the long term, but I think in the short term, they're still struggling a bit there. And the reason why is they're coming into the television advertising market with a very traditional kind of revenue model, like upfronts and let's sell only to the 1,000 largest advertisers. Meanwhile, you have companies that are treating advertising like a digital advertising market. And that's my own company, Mountain. That's Amazon in particular. And you see Amazon's ad business for TV, they had the confidence that next week they're just flipping their entire customer base over to an ad-supported model. That's because they have tremendous confidence on the ability to monetize it. And the reason for that is they have all of these digital ad buyers on their search business on the Amazon.com website. So I think Netflix, to really grow their ad business, they have to stop operating in the past on the business, using an old kind of traditional media business model. They have to enter the future. That's what Amazon's doing. That's what Mountain has led the way on. And if they do that, they're going to be very successful. As a matter of fact, I think if they do that, the stock the company can double in size. I think Netflix is almost a startup when you look at, in terms of like they just IPO'd, when you look at the potential on the ad business if they do it right.
So walk me through the amount of, okay, so if I'm going to advertise on CBS and I'm going to advertise on Netflix, how much am I paying for each? Like, how is that calculus going to change? And also, would I put ads on both?
Yeah, so as a traditional, we'll call it brand media buyer, you'll just go where the audience that you're trying to reach is, and in traditional media, it's age, and it's very traditionally targeted, and you're happy to do both. The problem that you're kind of alluding to is the brand advertising market is not growing. It grows 0.5% a year. So if you enter that segment of the market, you are in a market share war from day one, and you're seeing that in Netflix growth rate on advertising. It's growing relatively slow. But if you go over the digital market where Google and Meta and Amazon Mountain operate, it's like millions of e-commerce companies who are eager to be on Netflix, who are eager to be on every TV network, and there's a lot more growth there. So Amazon's doing it right. I think my general thing is Netflix will have a good year on advertising, Amazon will have a great year, and I think eventually Netflix will see where the real growth is and pivot over to there. So that's how it works.
Mark, I mean, if anybody who's looked at broadcast or cable television over the last several years in terms of the advertising, it's pretty much all healthcare. It's basically letting you know of all the conditions you're probably suffering from or could be suffering from, and here's the little acronym we're going to put to it so you can remember the name. You can go ask your doctor for this or that drug or procedure. Yeah, I mean, there's I don't see General Motors, I don't see Coca-Cola anymore. I don't, all that kind of stuff. What is the future of advertising for broadcast and cable television? Is there one?
That's what we've been talking about. Now compare that to looking at ads on Meta, on Instagram. Yep. It's all e-commerce. It's all products you may be interested in, and disruptive companies and things like that. So the TV industry is in a transition. NBC made an interesting announcement at CES. CES is at the start of the year in Vegas. It's a big part of the show is advertising, is all these big advertising companies. And they announced that 60% of the ads that run on NBC, linear, cable, and streaming, they expect to be targeted against people's interests and not just their age. And that's a big, big difference, because now that starts to enable e-commerce companies and other companies to treat television like they're treating Instagram. And so that's the transition from traditional media to digital media for television, and that is happening. And going back to Netflix kind of sees easy money in the old way, but I think the long term they have to be part of that. And the answer to your question is, all of those TV networks are going to adapt. They're going to go where all the emerging companies are with the emerging ad dollars.
So anecdotally, we cut the cord when my daughter was really little, right? But we're watching Hulu, and we have ads on Hulu, and she literally is like, "What is this? Like, why am I watching?" And she's like, "What's with all the car commercials?" She's like, "Who's buying all these cars? Like, what do I care about that?" Like, she literally blew her little brain about what actually was happening. I thought that was quite funny, but I think it's a deeper point to what you're saying on how to reach younger people who have no concept of traditional television and what advertising actually is.
Yeah, I mean, it's the death of another way to state it is we're going to watch the death of broadcasting and broadcast ads and see the growth of matched ads, so to say, ads that are really tuned to your household and to your daughter's interests and your interests and things like that. And all the advertisers want the latter, and they're slowly abandoning the former. They're moving away from the broadcasting and moving more in the digitally targeted television advertising.
All right, Mark, always good to touch base with you. Mark Douglas, founder and CEO of Mountain.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, "Alexa, play Bloomberg 1130.
Andrea Auerbach, she joins us. She's head of private investments at Cambridge Associates. Guess where they're located? Boston. There you go. Andrea, thanks so much for joining us here. I'd love for you to just kind of give us a lay of the land about the private equity venture capital marketplace here today. Is the money still flowing there? Are deals still getting done? What's the lay of the land look like?
Yeah, it's great to be here again, and check in with you all on the state of the private markets today. And the lay of the land is wintry and a little barren, if I might.
Right.
Transaction volumes have been pretty low for most of 23. We're hoping it picks up a little bit more in 24. But to just give you one indicator of how tumbleweeds are rolling through the town square, the rate of distributions back to limited partners, right? They're the investors in private investment funds, private credit funds, what have you. Distributions back to LPs are at their lowest point in about 25 years. That's relative to the market size. The market's grown, but that's a heavy statistic in a January, you know? And so there's more work to be done here, and the GPs are getting at that work.
Well, I mean, is it primarily been driven by this interest rate environment we've been in here? It's tough to get deals done, to get liquidity for the LPs. If I'm sitting on an investment here, is it primarily driven by the interest rate environment?
Exactly. With the zero interest rate environment exiting stage left and interest cost doubling overnight, it's definitely created a throttle back in GP's ability to work with their companies to generate attractive exit opportunities. And then buyers, like there's a big bid-ask gap right now, and you're observing this all over the place, as are we, because the next buyer can't borrow the same amount of debt to buy the company, and so they won't. And they won't pay for that. They won't pay as much either. And so we're waiting for a bit of a capitulation moment, maybe, to unlock a little bit of the pent-up demand for exits right now that the LPs are waiting for.
I mean, Andrea, I think the market would love that. In the meantime, it does feel, though, there's been lots of different ways to access money to give it back to LPs, and LPs going to private equity being like, I'm not going to invest more money until you give me my old money back, and then leverage upon leverage upon leverage. Is there trouble brewing here? Like, what's an unintended consequence?
Yeah, so you're absolutely right. And so transaction volumes are down. Fundraising for 23, I think you'd have to go back about 8 years to find another year that matched in terms of volumes are down, right? We have to look back 8 years to find another year that had this much capital coming in. And you're right about the leverage on leverage, Alex. It's the risk here is that GPs are feeling the pressure, and they're looking for ways to deliver some kind of distributions to LPs. And there's certain things they're doing. I'll do anything for a distribution, but I won't do that, is sort of the environment we're in. LPs aren't liking some of the financial engineering efforts that are going on, NAV loans being one of the hotter topics, if you will, in the LP and GP community right now.
All right, talk to us about what has been one of the most amazing growth stories I've seen in financial services over the last dozen years, which has been private credit. What's your thoughts on that marketplace, that asset class, and kind of the deals that are getting done there?
Yeah, I mean, so as we said, we were just talking about going from fourth to first gear in the private equity markets because of interest rates increasing as significantly as they have. It's really created a moment for private credit, if you will, to shine, Paul. And in that sense, the returns available for private credit investors, because interest rates are now what they are, because the transaction environment is slower, private credit may be able to put more bells and whistles in the forms of actual covenants on certain tiers of the market. And so things are looking up from a private credit perspective while interest rates are staying at the levels that they are. And in some ways, think about mezzanine, think about middle return private credit strategies. They could deliver a 13% return to an investor. It's kind of knocking on the door of certain private equity firms that might not be measuring up right now. So we're watching some stuff unfold this year that's going to be very interesting.
What do you like right now? Like, if I was going to put money to work, how much should I be putting to work, and where?
Wonderful question, and actually there's a lot of discussion around this, right? Because the public markets, as we know, have recovered quite strongly, and you've been talking about that and where those pockets of opportunity are. Private markets take anywhere from, let's argue, 5, 7, 10 years to really watch those absolute returns roll in. And so part of the debate right now, Alex, is should we keep it in publics or should we move to privates?
Yep.
Now, I live in privates. And so within privates, depending on what you're looking for, that private credit that Paul's talking about, very interesting if you have a fixed income allocation you'd like to offset with a little bit more of a return in the private credit realm. I'll give you an interesting spec from private equity. Venture valuations have been coming down significantly.
Yep.
And we're watching the returns come down, and it's definitely a lot of capital is cleared out of that particular market. As we talk about it here at Cambridge Associates, venture is looking very interesting right now, precisely because capital has been moving off to the sidelines.
All right.
Yeah.
Andrea, always a fascinating discussion with you. Always appreciate getting some of your time. Andrea Auerbach, Head of Private Investments at Cambridge Associates.
This is the Bloomberg Intelligence Podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live each weekday, 10 a.m. to noon Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.